If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
What's going on, everyone? I'm Shawn Winslow, and this is the Multifamily Money Podcast. Welcome back to another Finance Friday episode. Every Friday, we dig into finance topics to get your money working for you harder, smarter, and definitely longer so you can create the life that you want. As we all know, it's not what you make, but what you keep. And today's topic does relate to real estate for the fact that the Fed just raised rates. And now, what does this mean? You probably have seen this all over the news. And how is this going to affect you, both personally, maybe in your own home or as a real estate investor? And so that's what we're going to jump into today. Before I get into that, I just want to thank everyone who's tuning in every week. I see it in the numbers, and I just really want to thank you. I appreciate it. It just makes me feel like all the work I'm putting into this, is worth it. I do enjoy it, but I also want to make sure that people are getting value. So return listeners, that makes me feel like I am. So thank you so much. And as always, if you are getting value, I would really appreciate a share, maybe on social media or maybe just to a friend or family member who also could get value from this. That is always appreciated and helps everyone out. All right, so let's just get into it. And I think first we need to explain some, terms like what does Fed funds rate mean, and also like what did Jerome Powell, the Fed chairman's, what did that speech actually mean the other day? So first we'll start off with what is the Fed funds rate. And this is just simply a rate that banks trade with one another, right? So it's the rate they charge each other to trade money back and forth. And usually this happens, it's called the overnight rate because this usually happens overnight. Sometimes, banks will need to borrow some funds to do their operations and activities every day. And this isn't actually set by the Federal Reserve. It's just more of like a guideline and a range of where that rate should be, right? So for instance, since the pandemic, that range up until the other day has been 0 to 0.25%. So within that range, banks, when they lend money to one another, they trade within that range, so that they charge each other in that range a rate. So it could be 0.1, it could be 0.01, it could be 0.25. And so the other day, the Fed announced that they are increasing that range from 0 to 0.25 to 0.25 to 0.5%. And this will directly affect us because it's the rate, like I said, from which the banks trade with each other. And it's also the rate from when they put reserves, the bank's reserves, they have to put into with the Federal Reserve, right? So that's why you see the whole FDIC insured thing. So they put reserves in there, and that's the rate they get, charged to do that as well. So it's a trickle down effect, right? It's like in any business, when your costs go up, you pass those costs to your customers, right? Because you have to keep your profit margins at a certain place, right, to be profitable and operate. So you pass it along. It's the same thing here. When banks, when that Fed funds rate increases and it costs them more to do business, they pass it along to us. So immediately what gets affected first is obviously mortgages, loans such as personal loans, business loans, and credit cards. So those are the things that directly get affected first, and then it trickles down from there, because as stuff gets more expensive to, say, borrow and to operate a business or just your lifestyle, then you start to pull back either as a business or as a person, right? You don't spend as much. A business is not hiring as much or expanding as much, and a person maybe isn't spending as much of their disposable income. They are kind of hoarding it, investing it, saving it, right? And so then that affects the economy, right? Consumer confidence down, consumer spending's down. So that's kind of the trickle effect. Now, do I think that's going to happen right now? No. This was, a small increase. Yeah, it'll maybe stop some people from what they were doing before, but I don't see it having an overall effect, like a drastic one in the market. Now, he did say And this was the first time that he's actually been clear in kind of concise in what he is going to do. In the past, it's been like, yeah, we're looking to raise rates. Yeah, we'll talk about that at a future meeting, whether that happens. But in this case, he actually said we plan on raising rates every meeting. So that's a total of 7. So this is the first one. So 6 more this year. And it's going to be, that same average of 0.25 to 0.5% increase. So that could put us around the 1.9 to 2% Fed funds rate by the end of this year. So that's a pretty big increase. And so you'll probably hear other terms, whether he's, a hawk or a dove, right? They're saying he's hawkish, right? Because what that means when it comes to monetary policy, hawkish is, hawks are willing to allow interest rates to rise in order to, keep inflation under control, where, dovish is not. They want to make it easier for us all, right? And not hit us with high interest rates. So we've all heard now about Paul Volcker. He obviously in the 80s, when inflation was going crazy, he raised rates to where they were at about 18%. And so he was very hawkish. And this was kind of the first time Jay Powell has actually been really clear and concise and about being, hawkish. So we're going to see rates rise, but where are we currently, right? Like, how is this going to, affect us? Obviously, there's a lot going on in the world between, the cerveza sickness, obviously, but that seems like it's not really a talking point anymore. Supply chain issues, oil prices, Ukraine situation. There's just a lot going on, right? And then there's, I think, a lot of geopolitical stuff in the background. And there's been talks about, both China and Russia wanting to move away from the US dollar being kind of like the currency, that backs everything, like oil prices. And we've seen China in Africa turning it to the yuan, right? Their currency. And we see that Russia and China are building a pipeline, and they're going to trade in China's currency as well. It's not going to be backed by the USD. And so I think the move here is partly to combat that too. Like as inflation runs rampant, it means that underlying currency is being significantly devalued, because with $1 doesn't go as far anymore, right? You can't buy as much product. So I think that this is part of it too. Not only do we want to, get inflation under control for the everyday persons and stuff, it's not as much, but it's also so it doesn't continue to devalue and erode the currency, which would severely affect us all, and the global economy. So that's a big part of it. But like, how's that going to affect us, as right out of the gate? And so obviously, the whole oil thing is a whole different conversation, but, we're going to see mortgage rates go up. They already have. They were at below 3% last summer, and now we're at above 4%. And I was looking up some places are quoting, 4.25%, and then some I'm seeing even 4.8%, but I think that's a little aggressive. I would say it's more around the 4.25% to 4.5% range. But that's still a significant increase. Like, I'll just pull up a mortgage calculator here if we take a look. So the average home price in the United States right now is $374,900. And so currently, if we were to do, well, it's quoting me right now at 4.859%. So it thinks that's kind of what the going rate is, which is $1,980 monthly payment. So $1,980. Now let's just say it was 4.5. That's $1,900. All right. Well, what if we got that same payment, or what if we bought the same house for that same price just last November? Rates were at 3.1%. That's $1,600. So that's $300 a month less. Now, let's say we got it back when it was around like 2.8 over the summer. $1,540. So we're talking about, a $400 difference, about, let's just call it a whole number, $400. So per year, That's a $4,800 difference that you're paying. That's a lot of money for the same house, same price. Over 30 years, that's a $144,000 difference. So you're paying $144,000 more for that 4.5% interest rate versus 2.8%. So that's a big difference, and that's why we've seen the prices skyrocket, because it was so much cheaper, like a monthly mortgage payment, right, for something that's 2.8%. That's why the prices were driven up, because you still would pay less. And now, is this immediately going to affect home prices? No, I don't think so. I don't think we're going to see them, increase as much drastically, right? That's gonna cool down, but I don't see there being a correction where prices are actually going to dip. Obviously, every market's different, but we're still in a housing crisis. There's still not enough supply for the demand, so that's still going to drive it until we start seeing rates, above 5%. I don't really see anything really contracting like that, because if we look at it, the current or historical rates in the last, say, 15 years have been 5 to 6% mortgage. And this is for a 30-year fixed, and we're not near that. We're at about 4.5. So there's still ways to go on that front. So I just don't see any type of major contraction right out of the gate. Now, another good indice to watch is the 10-year Treasury. That generally is very indicative of where the 30-year mortgage is going to go. So it has been increasing, right? For a while, it had been below 2% for a very long time, and now it's at 2.157%. And I checked this as of March, the morning of March 18th. So if this continues to go up, I know in my last episode I talked about we got to look out for the yield inversion, and that's given us a little more buffer right now. And so I did mention that, where you want to look out for a yield inversion where the 10-year yields less than, say, like the 2-year, because that's you're supposed to be paid more for a longer maturity, because obviously more stuff can happen in a longer period of time. So it's risk reward. You get paid more for a longer duration fixed income product, a bond, right? And last time I mentioned was around 0.24. It started to, or 0.23 actually, and it started to move back up, but it hasn't drastically moved. It's at 0.26. So, we're still within 20 basis points of yield inversion, but I feel it'll continue to trickle up unless something drastic happens. And what we've seen over the last, few months, or even last 2 years, drastic things can happen. But that's kind of where we're at in terms of mortgage rates are at, and that's for residential. And I talked to one of my lenders for the commercial side of it, right? So because obviously I buy large multifamily apartment complexes, and so commercial rates tend to be a little higher than residential. And I haven't got where actual rates are. I'm still waiting on that rate sheet. But what they told me, just as you're underwriting, you obviously need to put in, a market rate when you're underwriting a property, when you're doing analysis on a property. And just to be safe, they gave me, rates for the time being to use when it comes to bridge debt and for agency debt. So those that aren't familiar with those terms, bridge debt comes from, a bank, could be a regional player, national player. And what bridge debt, generally use bridge debt. Well, there's multiple reasons, but usually when you have a heavy lift, the numbers aren't going to look as good right out of the gate, right? Because you're going to be repositioning the property. So agency likes to see occupancy above 90%, and they are debt to yield numbers, and debt coverage ratio, DCR, are, they look for a higher number than, say, a bridge lender, because they just want more stabilized, higher quality. Whereas bridge debt, they like this type of deal where you're going to be improving it. But obviously those metrics, the debt yield, the DCR, the occupancy are not going to be as strong out of the gate, right? Because you got to reposition the property. So you got to take people out of the units to turn them. But then you'll be charged a little higher rate, and terms are not quite as favorable as agency, right? It's the whole risk reward thing again. Right now for bridge, 4.25% to 4.5%. And generally that's like could be, a 2 + 1 + 1 + 1, or it can be a 3 + 1 + 1 + 1, meaning, you have 3-year term, and then you can add a year, adding up to 5 years, and then you can refinance out into agency, something permanent. And generally we try to do it in 3. That's kind of the goal. It all depends. Every deal is different. Sometimes you'll go the whole 5. It all depends obviously where rates are. And then for a 10-year term, 30-year, 25, probably 25-year AM on an agency side, 4.5% is just to be safe. You probably get a better rate, but that's just to be safe for the time being. So that's kind of how you want to underwrite. Obviously, this is obviously fluid, but that's kind of where it seems like things are shaking out. So that's where I'll be underwriting in the meantime, and where I would advise anyone else to be underwriting. And then in terms of exit caps, that's all up in the air. But I always, exit caps and rates, I tend to just go higher than what it currently is, just to cover yourself. Because what if that does happen? Will the deal work or will it not? Obviously, you can do, a base case, a best case, right? So the base case could be like rates are 4.5, and then we go to exit, they're at 5.2, right? But my best case is they might stay the same. I never try to make it better, because that's just too optimistic in my opinion. I just think it's important to always be conservative and a good steward of investor capital, right? So that's kind of where we're at with the Fed funds rate. And there's another thing to bring up too. I mentioned that there'll be 6 more Fed meetings, and Jay Powell said that they're going to raise it every one. Well, a good thing, and I think part of the reason why he was so clear and concise is because there's going to be a few chairs that are actually being they're up for election, right? So, or up for appointment. So there'll be a few of the Fed chairs actually leaving and new ones coming in, and depending who they are, they could be hawkish, they could be dovish. So I think he wanted to get ahead of it and just be like, no, we're gonna be hawkish, and this is clearly baked into the stock market, right? Because the market has been taking a dip since the beginning of the year, right? It's been very volatile, and we've seen some huge drops, but since then it's been coming back, and that's because that was already baked in to the market. So I see us in a good position. Obviously, things can change. Labor market's very strong. Minus supply chain stuff, there's still consumer confidence still seems to be there. People are still trying to buy stuff. Historically, the rates are still below historical averages. So, and I'm a net buyer of real estate, and what I mean by that is I always buy real estate. Obviously, I'm still opportunistic. I'm still a conservative investor. I'm not just going to buy to buy. Still got to be a good deal regarding my criteria. But if it's a good deal, I'm going to buy it, right? It's not necessarily what's going on in the market. As Warren Buffett says, he's a net buyer of stocks, and what he means by that is, like, we're all net buyers of food, right? We all need to eat, and if you go into the grocery market and prices are up 20-30%, you're still going to buy because you need to eat, right? Well, I need to invest because, 1, that's my business, and 2, everyone needs to invest to grow their wealth and grow for retirement, right? So you always need to buy. Obviously, you got to be prudent, still a good investor, and stick to whatever your metrics are, your criteria. But just because what's going on in the outside world shouldn't stop you, right? So over the long term, if you buy, that's where you create true generational wealth. It's a buy and hold strategy. No matter what type of investment, that's how you make true wealth, especially in real estate. So that's what I'm going to be doing. We're still underwriting a crazy amount of deals, trying to find a good one. And that's what it takes. And we're still going to be net buyers. We love real estate, and that's why we're in it. All right, everybody. I hope this brought you some value. As always, any questions, just reach out to me. Instagram's one of the best ways to connect. Shawn O Wins is the handle, or you can find me on LinkedIn as well, Shawn Winslow. And then as always, if you want to learn more about what we do, our website is greenbriercg.com. That's Greenbrier Capital Group. Check us out. But as always, thank you for tuning in, and I'll catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course, share it with a friend who needs it. See you next week for another great show.